Good morning, ladies and gentlemen, and welcome to the FLOWTECH FLUIDPOWER PLC results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please simply just type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you give that your kind attention, we'd be most grateful. And I'd now like to hand over to Bryce Brooks, CEO, and Russell Cash, CFO from FLOWTECH FLUIDPOWER. Good morning to you both.
Yeah. Morning. Good morning. Well, good morning to everybody who's joining us today. This is the first time we've used the Investor Meet Company portal, and looking at the people who've subscribed for this presentation, it appears that we've got a mix of one or two who've known us for quite some time and therefore will be well aware of the story. But equally, we've got a number of people who may be hearing about FLOWTECH for the first time. So what I'm going to quickly try and do is, in the first 5 minutes or so, try and bring everybody up to speed a little bit as to who we are. So hence we're starting with the slide deck in an appendix, and then I'll proceed into the main bulk of our presentation. That bulk of the presentation will broadly cover sort of three areas. We'll talk briefly about the effects of COVID-19 on the organisation. We'll then talk to some degree about the financial outputs from that, obviously quite different than our normal financial performance. And then I'll major on some of the key strategic decisions that we've taken and how we're developing our strategy as we hopefully evolve from the COVID year and move forward into 2021 now and into 2022. So in terms of the background to the organisation, a little bit about our leadership group. Obviously, I've got myself. I've been with FLOWTECH for 10 years. I joined the organisation in 2010. It was already a well-established, previously family-owned business that had moved into a private equity world. The private equity investment spanned the initial financial crash, so it had challenges in its balance sheet in 2010, but fundamentally it was a very strong business. So I was the CFO at the time, working with Chief Executive Sean Fennan. And we developed the business from 2010 to 2014. We floated it on the AIM market. I stepped up to Chief Exec in 2018 when Sean retired, and I was joined by Russell Cash. Russell, it may be useful if you give yourself an introduction.
Yeah, as well as having a little bit of a strange name for an accountant, my parents once upon a time must have had a sense of humour. I've got a fairly, so I suspect, a different type of background to most CFOs of quoted companies, in that I spent over a quarter of a century in the world of turnaround and restructuring. So joining Bryce at FLOWTECH 2.5 years ago was actually my first venture into industry. But I didn't know it at the time, but obviously some of the challenges that our friend COVID threw at us, I was able to dust off some of the turnaround is not the right word, but you know where I'm coming from. These, steady head and stabilisation type piece being quite useful. So within my DNA, I guess, is a lot of stuff around controlling cash and controlling costs. And I think 2.5 years on, if you follow the story, you'll begin to see some of that coming through quite strongly.
So in terms of the remainder of the non-executive team, we're led by Roger McDowell as chairman. From 2014 to the change in 2020, we had Malcolm Diamond as chairman, who's got widespread experience, former chairman of the year, chairman of Trifast in terms of his main legacy business. But Roger stepped up on Malcolm's retirement last year. Roger has extensive experience across a number of businesses. He's currently the chair of 3 other organisations. And in terms of style, there's probably a shift in style from under Malcolm to under Roger. Very process-driven, very proactive, and active in our management style, which is something that certainly Russell and I welcomed. Nigel Richards has been a continuity person right the way through from Float. Very experienced audit partner with PwC, in charge of their technical department before retirement 6 or 7 years ago. So Nigel chairs up our audit remuneration side of things. And then more latterly, we had the appointment of Paul Gedman. This is Paul's only PLC appointment, but his heritage is firmly in e-business. He was one of the key protagonists in the development of the Hook Group, working with the chief executive there, Matt Moulding. He left the Hook Group as part of its flotation last year and is establishing now his own portfolio of interest, but all with an e-business and data element to it. And hopefully that'll be one of the things that you see as we move forward. In terms of the overall backdrop to the group, well, we are a specialist niche industrial distribution business focused around the fluid power market, that's hydraulics and pneumatics. We distribute for the vast majority of the major global brands, and we employ around 620 people in the UK, Ireland, and in the Netherlands and the Benelux. But the predominance of our business, the vast majority, is based around the UK and Ireland. Currently, we trade out of about 19 sites, but as part of an M&A program, that's reduced significantly from 27 sites 3 years ago when we completed our last acquisition. So we are in a process of reducing our overall footprint, and obviously with the improvements in operational efficiency that come from that. We are split from a reporting perspective and very much from a management perspective into two discrete divisions. There's been some developments in this that I'll talk about in the main book of the presentation, but the core of our activity is in component distribution with a lot of technical added value requirements that come from that. So yes, there are elements of it that are fast-paced, high service driven, but equally there are evident elements of it that require in-depth technical insight to assist an OEM, for example, with the development of a new hydraulic circuit on a piece of construction equipment. Complementary to that is a services division, largely involved around the production of power packs, purifiers, on-site activities, specifically around hydraulics. And therefore, we have a services division that sits in a complementary manner to our core components activities. In terms of the overall market size, in the UK, the fluid power sector is assessed at broadly pre-COVID levels at around £1 billion. Obviously, in keeping with many sectors, it's had some challenges through 2020, but it remains that the market dynamics believe that there will be a return to normal levels, in the period 2022-2023. Therefore, it's a sizable market, and we are the largest player as a result of significant development post our float in 2014 in the UK and Irish market. Overall in Europe, circa 13 billion. Globally, 46 billion in most of the westernized economies, and in total, I've seen certain commentators talk about a 100 billion market. You can see on the right-hand side of this slide, it's very broadly set in terms of its key areas of focus. There is a heavier slant towards construction, as the nature of it, general engineering, and in our sense, we also deal as a master distributor through other areas of distribution, so there's a heavy resale market. So the key takeaways from this are FLOWTECH is sizable. It's the largest player in the home geographies of the UK and Ireland at circa 100 million in terms of our current volumes, but it's circa only about 10% market share. In terms of what's addressable to a pure distribution business, that may be as low as 30, but at size 50%, depending on the precise criteria that you apply. So again, we are circa 20% maybe of that addressable market. So a big market and lots for us to go at from that perspective. Okay, that hopefully gives viewers a sense of the backdrop to the overall sector. So at its core, we are a distribution business, focused business with lots of added value elements to it, services, technical, high service offer from that perspective. In terms of the key aspects of our proposition from an investment perspective, well, we operate as the largest player in a fragmented marketplace. Our footprint is sizable, both in pure geography and in the reach that we have with all the major global manufacturers. So the likes of Eaton, Danfoss, Parker, Bosch Rexroth, Festo are multi-billion global manufacturers who require a highly efficient, technically competent, strong e-business, digital-based distribution network. and very much our growth potential is housed in the organic growth that we can generate from that position, but in time, and as we've done historically, can be added to with complementary acquisitions. And suffice to say, our leadership team, we believe, is quite well experienced, is ambitious, and is now enhanced by some developments we've done this year, adding to the bandwidth and skill set that we possess. COVID-19, clearly we all know about this and the effects of it, and we want to just enshrine in one slide maybe the key effects, and Russell's going to lead in terms of the financial aspects of this.
Thanks, Bryce. Bryce uses a word, I refer to it as a 5-letter word beginning with C. The graph on the bottom of this slide, the dark bar is the normal year of 2019. The lighter coloured bar is the annus horribilis. I'll use the Queen's expression there. And just to get some numbers in your head, in terms of the story of the 4 quarters, Q1 is actually an 11% reduction comparative to 2019. We were actually pretty pleased with how we were going, but of course the first national lockdown, the 23rd of March, the last 8 days of that quarter rather dampened the numbers for the entire quarter. Q2 was the quarter horribilis, where overall we were 33% down. And within that, the month of April was 41% down. Things got much better or less bad. It depends if you're half full, half empty. We were 14% down in Q3, and Q4 only 5% down. So we've had, if you like, a nice gradient to our road to recovery, and pleasingly that's continued into Q1 of 2021. But the type of the slide has been chosen carefully and deliberately, in summary, recovering rather than fully recovered from COVID. It's important to reference that Q4 5% down is against a weak comparative, actually. As I said, Q1 this year has started well, but we are still some way behind Q1 in the normal year of 2019. Second point, before handing back to Bryce to cover the remaining 3, it's an obvious point, but we've took the opportunity to refresh our banking facilities with Barclays Bank. We did that last November. We've got a further 3 years of facilities with the same aggregate 25 million pound notes. And obviously and clearly sensibly, we took the opportunity to revisit the key covenants. In particular, we reset the leverage covenant, which would have tripped us up had we not done so. Again, obviously because of the lack of underlying profitability caused by the 5-letter word beginning with C. One more thing before I hand to Bryce, just for those of you who's followed us, you'll see that at the end of 2020, broadly, a small element of rounding, but broadly we're carrying 50% of the debt burden that we had 2 years previously.
In terms of the operational effects of the COVID crisis, in keeping with many businesses, we've absorbed thousands of hours of management time dealing with what we had to deal with. One of the aspects of our business, we operate from Cork to Belfast to Rotterdam and several points in between, but we have 2 major sites in Skelmersdale and Leicester, both of which you may recollect were in the centre of COVID-19 outbreaks, hotspots, back in the good old days of a tiered system. And we're very pleased with the fact that both those sites remained open throughout. There were no operational days lost. All our sites were able to achieve full safety compliance with all the protocols that were necessary from a modern business such as ourselves, and we're pleased with the way that's worked, and we'll talk about our employee engagement scores later in this presentation. But probably one point of note is, as we all recover commercially from this particular aspect, at the moment there's significant knock-on effects into global supply chain. Some of it for very good reasons, that the demand is increasing quite significantly in terms of filling back up that stock hopper, so to speak. But we have a supply chain that is European dependent, and to some degree, as all supply chains do, a more global aspect, particularly from the Far East. So we're seeing certain drag effects on that in Q1 and into Q2 now, with availability of stock in certain areas. Not hugely material at the moment. We're dealing with it very positively, but there is an element of drag, and therefore the outlook for the remainder of this year, we believe, will still have certain of these sort of drag effects.
Okay, a few more numbers. We've probably said sufficient on revenue. I think, as I said, we are encouraged by the start to 2021. There is a school of thought that there's an element of confidence being created in the UK through the relative success of the vaccine rollout, and equally perhaps combined with an element of concern from certain customers in terms of supply chain and Brexit type impact. Maybe there's some of our customers who are filling their own shelves full of stock a little bit at the moment, but we're certainly, if it's a honeymoon or a bubble type period, we're certainly encouraged by what we're seeing. And that's to the gross margin point. It's not only revenue which we're encouraged by, it's the quality of our gross margin. On the face of it, this one slide in isolation shows 146 basis points reduction in our GP, but don't be alarmed by that. The points I'll make are that 2017 we were at 33.8, and over a 2-year period we felt we did a pretty good job of transitioning an already very strong margin up to 35.7 that you see in the right hand column, and the fact that it's dipped down a little bit is fully explained. 3 key reasons. There's 2019 enjoyed the benefit in margin terms of some income from the sale of our hard copy catalogues to a number of our customers. Bryce will come back to perhaps that's a little bit old fashioned going forward. Secondly, the detail around the cost that we put above the gross profit line, it does include some direct labour costs, and I guess the audience will appreciate that direct might be a little bit of a misnomer in the fixed nature of an element of that in a year in which your volumes suffer. Thirdly, the mechanics, I really won't bore you with this one, but the mechanics of our consistently applied stock provision means that, again, the lower volume caused by that 5-letter word beginning with C, it is no favours. But all in all, we're pretty proud of that margin, and within all of our DNA is, not to sacrifice margin one iota in the pursuit of revenue. So in terms of costs, again, those who have followed us will have seen our ambition to take old world inefficient cost out of our businesses, and fairly obviously that was centred around people and properties. So in terms of the people, our headcount reduced by 7%, 45 heads in 2020, and that's against a circa 20 million payroll bill, so 7% of 2 million. And equally, we have sort of exited 5 properties, and that's typically where we put the previously sort of relatively inefficient warehousing picking operations into our much more efficient locations in Skelmersdale and Leicester. So we've delivered on the significant majority of what we set out to do. We've still got bits of it to complete in the next 12-18 months. And maybe there are certain things which we're beginning to identify that might add to that pot in the fullness of time, stressing the fullness of time. So if we've taken, if you like my expression, the old world inefficient cost down, we've sensibly chosen to invest in some new world investment areas. Bryce will touch on these in a few slides' time, but I just headline the business and digital agenda. I emphasise e-business rather than e-commerce. Bryce will explain our view on the difference there. And equally and importantly, we've invested in 4 or 5 senior people, top quality people, who sit immediately below the PLC board level and significantly strengthened our management team. In terms of the debt, on a like-for-like basis, it's reduced by £5 million in 2020. And I can add up, as my profession would suggest, it's 5.9, the difference between those first and last bars there. The 0.9 is the element of support from Revenue and Customs. You'll be aware that they allowed UK corporates to defer the payment of the Q1 2020 VAT. So £5 million on a like-for-like basis. I think the point that leaps out here, of course, and it equally leapt out of the 2019 equivalent bridge, is that over the 2 years we've taken 13 million out of our working capital, and that is one of the key reasons we're operating at a debt at roughly 50% of what we had 2 years ago. If we were to do a go forward bridge, really important point, and in some ways a very obvious point, is that if the working capital blob has been big in green in the last 2 years, it's going to be quite big but red in 2021. And clearly, as volumes begin to return, hand in hand with that goes an increase in our receivables book. And equally, from a position of relative strength to our sort of fragmented UK competitor base, we do feel it's wise to put a little bit of stock back onto our shelves to take advantage of perhaps some pent-up demand and make sure that we certainly limit those examples of where we ain't got quite enough stock on our own shelves. So we think that's sensible investment of the headroom we've created within our banking facility. But 2021, those of you who have looked at either the Zeus or FinCap analyst notes will have noted that we're not anticipating much in the way of debt reduction in 2021. In fact, it goes as far as to say the only green blob, hopefully it'll be a much bigger green blob, is the cash generated from operations. Everything else will be red, and that green will equate to the aggregate of the reds, really. So little debt reduction in 2021 is the headline.
In terms of my own take on input to investors who are new to our position, as Russell's outlined there, if there's disciplines within how we operate, it's an absolute focus on gross profit percentage. So we get reports every day from all our businesses on day GP, month-to-date GP, comparison to last year GP, and comparison to budget GP. It is the absolute DNA of how we operate, and investors should take some degree of confidence that the 35 percentage points of GP is the consistent output that you get from this particular sector, and we view as a significant strength. Beneath that, we're very disciplined around the cost per transaction, so cost per drop, cost per pick, cost per order, the fundamental flow of operational cost, and a key aspect of what we've worked through in the past couple of years, both in our KPIs, our reporting, our actions, our management, is all based around ensuring that we tighten as much as possible the cost of dealing with our per transaction elements. At the same time, we've chosen the benefits we take from that to build additional resources and specialisms that are building the platform for us to significantly move the business forward from an organic perspective. And at the same time, one thing that in the earlier days of our time in the market, certain commentators criticised us for was the management of our working capital. And hopefully, observation of our numbers over the past 2 years was, as Russell said, 15, 16 million taken out of our working capital investment. Some of it, through the natural reduction from COVID-19, is another discipline in which we're very strong. In terms of development in our overall group strategy, as part of the new constitution of the PLC board, we put together an outline strategy paper for the back end that went through full analysis with Roger McDowell and the remainder of the NEDs, and the key aspects of which I'm going to take you through now. We believe this is building the platform for organic growth, cash generative growth over the long term. In terms of branding styles, we've historically operated under independent traded profit centres with local brands that actually have long-term heritage. However, for two reasons, the Amazonisation of life in the progressive move to online platforms means that multiple separate trading branding styles does not resonate in an online world. And secondly, the demands of our customer base. We are clearly seen now as the largest player in our marketplace. We operate with same customers across multiple businesses. So you would have had 4 or 5 accounts syndrome working in here. So we've decided to progress to 2 branding styles, FLOWTECH and Fluid Power Group. FLOWTECH will cover our high service offer, typically historically catalogue biased, but increasingly online biased operations. And it has a heritage in high service, wide stock availability, and strong technical competence. However, it's very closely associated with that type of offer. Whereas in the Fluid Power Group side, strong technical competency based largely with OEMs is what that has a heritage in, and we've chosen to use the fairly broad branding style of the Fluid Power Group. Obviously, FLOWTECH, Fluid Power Group, that's all equally the name of our PLC. This will all sit under a single e-business architecture. So a transition to 2 brands commercially over the next year and 2 years, different speeds depending on the circumstances of each particular business. However, in terms of our reporting segments, we internally report 3 segments. We split Fluid Power Group into 2, one very much sharing the operational resources with their heritage in the FLOWTECH operation, and the other our services business. So the commercial market will see 2 brands, but our investor community will see 3 trading segments. 2 of them, FLOWTECH plus Fluid Power Group Solutions, are the historic components reporting, and therefore there should be a clear chain of reporting that people can keep track of. As we've talked about behind that, we've got a significant investment in e-business platforms. What's the difference between e-commerce and e-business? Well, FLOWTECH has always been seen, as the leading player in the e-commerce world. It's an order portal where we've got a wide range of stock available. Our customers input, they can search on that, but it's not what you would call a leading edge product in the modern world. We're going to transition from that e-commerce environment to a fully fledged e-business environment. This will include a hugely expanded product set, both available in stock and integrated with our own supply systems, and search capabilities that are, again, commensurate with the modern world and a significant improvement on what's available now. Behind that, yes, there'll be my dashboard capabilities, modern aesthetics in terms of the look of the site to appeal to the progressively younger buying fraternity who are dealing with this in this particular sphere. And then there is an element of future-proofing. At the moment, our websites are hard coded into our legacy ERP systems, and we'll talk more about our developments on that in due course. But it'll be a much more flexible, future-proofed resource that we're investing in here. We have around 11,000 live accounts traded with us in 2020. Over the last 3 to 4 years, we've had as much as 17,000 different accounts over that period who interact with the business. So an enormous amount of data coming into the organisation. And when we couple that with the development in a new customer data platform, we believe that there's significant value that can be extracted from this. We'll create the golden record of a single view of a customer. Behind that, the insight we're going to get at a product set, a supplier set geographically, is going to be of immense value to us, and we believe that will have commercial use for us in developing organic sales with our current customer set into new customers, and equally sharing the benefits of that with our major supplier and customer partners. So rather than being a link in a chain, which distributors have historically taken, will be a key part of that particular jigsaw. The investment in this is relatively modest in overall online terms, but for our organisation is quite significant. So we've started this process in 2020, invested there, but in 2021, it'll be around about 1.25 million, a mixture of OPEX and CAPEX. We start to get go live later on in the year, hopefully into Q4, and we're on track at the end of an 18-month implementation period, and we get significant traction in 2022 and beyond. So the whole e-business and data agenda, becoming a data-driven organisation, is a key part of our strategy. And we will believe will be an enormous differentiator from our historic, smaller, typically owned and managed competitor base in the UK, both in resources and technical ability. In other areas, we know that our services division, that's now clearly defined, both reporting and operationally as part of the work we've done, is clearly underperforming from a financial perspective, and our immediate aim is a return to profitability. Budget for 2021 is a profit, and we are on budget. The investment in this particular section of our business is around about 4 million. So our view is a minimum return on capital of about 20% is an immediate goal, and we're confident that we will achieve that in the short to medium term. But we're doing a complete root and branch review of the organisation. In this year alone, we've changed the leadership team, the leadership grouping. We've improved productivity measures. We've changed our pricing methods that's improved margins, and that has stuck, and we're very pleased about that. And every aspect of its governance, from health and safety, technical capabilities, minimum educational recommendations, are all being implemented. It's a key part of what we do, but clearly it's got to wash its face and be fit for purpose financially, and that is something that we're going to have a strong and careful eye on as we move forward. In other major areas, we talked a bit about our investment in our extra skill sets. We've now established a management board with skills covering leading edge operation and development capabilities. Stephen Ashton is appointed to the new role there. He'll cater for all our logistics, long-term supply chain planning. We've split our operational leadership between Nick Fossett and Ian Simpson, both with long-term leadership roles with us. We've now added to it in product quality, engineering compliance, systems and IT, and in HR issues, which we'll talk a bit more in our ESG agenda. Target markets, absolute clarity in the UK, Ireland and near Europe with our Netherlands operation. However, the commonality of supply with these very large global manufacturers means that near Europe and further afield will always be a potential fertile market to us potentially, but absolute focus in the UK, Ireland and the Netherlands for the medium term. Beyond that, we currently operate out of 4 legacy IT business process systems, all of them resilient and in cloud-based infrastructures. However, there is a sense that in order to improve in 2 particular areas, one, long-term resilience. Our main IT environment is around about 20 years old, fit for purpose for today. Without question, in the medium term, that will become a more stressed situation. But equally, there will be productivity improvements that can come from certain areas of a modern ERP package. We believe that our investment in IT resources, project management resources, and we've done 4 system changes in the last year alone, our overall resilience means that we are set to be able to take on that type of challenge. And I'm confident that we will be able to achieve that by at least 2024. So we're starting that process today. Just to reiterate, though, our investment in the business platform is very much capable of being hooked into any ERP provider that we look into, so there will not be any material cost associated with that particular transition. This is very much around warehouse management capabilities and in the key sort of commercial sales order processing, purchase order processing environments. So overall, those are the key strategic initiatives that we're working on currently. And all of this is about building the platform for organic sales growth in market share in those home geographies. ESG is a high on many investors' agendas, but for good reasons, it's high on our agenda, and we're looking completely at our environmental impact and our employee impact. Russell.
Yeah, and it's clearly increasingly important to the investors, as Bryce says. It's clearly important to ourselves. Bryce will touch on some of the stuff which we're actually quite proud of in terms of the way we've treated our people, certainly during the pandemic conditions, but we'd like to think prior to that as well. And on the environment piece, we recognise that we did need some help, so we engaged with an organisation called Carbon Responsible. They've spent some time, relatively deep dive into the activities in each of our 19 locations, and I guess fairly obviously begun to talk about setting targets around CO2 emissions linked to the number of people we've got and the quantum of our revenue. We got a session in about 3 or 4 weeks' time where we'll build on the initial work they've done and develop and refine those targets and clearly report back to our investor base as to how we're doing. Part of that session we'll begin to talk about the Scope 3 emission piece. We'll understand what that relates to, but suffice to say we've always been keen and we remain keen to have partners who take these things equally as seriously as we do.
In terms of employees, obviously many businesses talk about the value of their employees, that's all you have, and we're no different from that perspective. And the COVID period tested that particular culture to the limit, and I'm pleased to say that we came through that in our view with flying colours. We're a multi-site operation. As I said, we trade from Cork to Belfast to Rotterdam, all points in between. So with the inability for leadership group to travel during the various lockdown periods, it was really down to our local management teams to manage their specifics, and they've done a fantastic job with that regard. In terms of mental health, again, high profile through the past year, and our industry is very traditional. It's previously not been a leading light in this area. I'm very pleased to say we were the first business in our sector, in our governing body, the BFPA, who grasped this particular situation, introduced mental health first aiders. We have mental wellbeing support through an enterprise employee assistance program, not just for employees, but for their close family members, that had a great take-up during the course of the year. We test, or we score ourselves in terms of overall employee engagement, introduced in 2019. And despite COVID-19, we had a big step forward in the response we got from that perspective. Still more to do in terms of overall engagement scores, but we're very pleased in how we develop, both in how we deal with people and how we nurture and develop talent as we sort of move forward. Capital allocation.
Okay, a posh expression for what we're doing with our pound notes. So I think in the course of the last half hour or so, we've demonstrated that we're not short of what we believe very sensible areas to invest in. Our discussions have ranged from the position of strength, putting some stock on our own shelves, to the potential sort of game changers of e-business and ERP systems. We've not touched too much, so I'll just mention it now in terms of our key warehousing and logistics centres in Skelmersdale and Leicester. They're already really impressive, in my view. But we recognise that let's not rest on our laurels. There's probably a bit more we can do to make them more efficient still, all designed to ultimately deliver that cost per pick metric of £2.40. We obviously remain mindful of the ongoing need to control our debt. You're sort of only as good as your last year type mantra. So that will definitely remain within our mindset. And thankfully, like I said, we've generated healthy headroom within the bank facilities and within the banking covenants, but we do respect that. And equally, we know that certain investors, the dividend remains either important or really important. But the key message there is that the dividend will not be formulaic. Pre-pandemic, it had reached the position of 6 point something pence per share, or put another way, £4 million. Put another way, a yield of 14 or 15% when the share price was 44p one day last year. So it won't be formulaic, and you'll have noted that the analyst sort of notes have penciled in sort of 2 pence per share as a final dividend in respect of the year we're currently in. And clearly we don't think that's out of kill. At that level, we would view ourselves as in with the crowd in terms of the yield, rather than an outlier in either direction.
I mean, for those who've been and followed our story from 2014, we've always seen ourselves as a cash generative business, and therefore looking to pay a dividend. If there was one observation I can make on the period where we set ourselves with a 5p dividend rising to over 6 pence, the scale of investment opportunity and the potential for organic growth is one that we underestimated in those early days. So this, I think, is an absolutely sensible reflection of the fact that shareholders have typically many times said to us, why you're not investing your cash in that particular growth. And I think we're using this obviously change in our approach, born out of, yes, the COVID period, for us to reassess that. And I think what we've outlined over the course of the last couple of days in our attitude to this, hopefully will resonate with the majority of growth-based investors, but equally appeal to those who like the income element of our potential over the sort of long term. So, okay, in terms of summary, we believe we've dealt with COVID-19 well. But beneath that, we've continued to work on extracting efficiencies from our network, our mantra around the cost per transaction element of things. We've, yes, invested overall in our systems, in our people, our management skills and bandwidth, and we've ensured that we control our working capital. The key aspect there is control. However, as we transition into 2021, we'll develop our branding style, both for commercial benefit. We're investing significantly in B2B business and data, becoming a much more data-driven organisation. We will ensure that our services division reaches as quickly as possible a sensible financial return for its overall position in our group. And as we've talked about, we believe significantly that the development of a long-term sustainability plan covering environmental and people-related issues is a key part of what we should have as an offer. Our outlook overall in terms of trading in the first quarter of the year, we are slightly above our expectations. We're cautious and sober. We reintroduce guidance to that in terms of our outlook from that perspective. You'll hopefully guess I am sober from there, but generally we feel quite positive. Both revenue and margins are going in the right direction. And in terms of outlook for the medium term, if 2019 is a benchmark at 112 million, we think at the moment the outlook looks reasonable that we could exit this year at around those levels as a run rate. The analysts have set ourselves, I believe, at consensus, as I've said, about 102 million, and we're not uncomfortable with that as a starting point. But hopefully we've got a more positive mindset beyond that particular point. That completes the presentation in terms of its overall content, and hopefully we can now enter into a Q&A period.
That's brilliant. Bryce, Russell, thank you very, very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard, and we will send you an email to notify you when that's ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Bryce, Russell, I know I haven't given you an awful lot of time to look at the questions that have been submitted today, and I can see you're doing a very good job at opening the Q&A tab on two screens at the same time. But if I could just ask you to open up that Q&A tab, Bryce, on the right-hand side, if I could ask you to read out the questions and perhaps give a response where it's appropriate to do so, and then I'll pick up from you at the end. As I say, if you could read out the question, that'd be most grateful.
Okay, well, great. Well, we've got a number of questions, so we'll try and canter through to use our time wisely, which thank you very much for very much interest we've got here. So first question, how do you look to expand your reach beyond the UK given the potential size of the market opportunity? Will then be organic or through M&A? Well, there's two elements to this. Firstly, obviously, e-business platforms are cross geographies. There is a sense that the operational footprint required to support an online capability could either be our own or we could outsource that into one of the major logistics specialists, DHL, TNT, etc., in Europe. And just to reiterate, we have two training businesses in the Netherlands with a view that we could certainly use the operational footprint there to expand an online platform. But as we talked about, absolute focus offline plus online in the short term is in the UK and Ireland. We believe the extent of opportunity there for us to grow organically and inorganically in due course is overwhelmingly positive for us. However, as I said, the product set is universal and global. So without question, we have the potential to grow further in Europe, something we've looked at extensively in the past and will definitely be on our agenda again, but more in the medium to longer term. Are there any new products or areas where you could move into that are complementary? Well, yes, we have adjacent markets, particularly in industrial valves, actuated valves, electro-hydraulic systems for sure, in those particular areas. And whilst we talk specifically about fluid power, that sort of 1 billion market in the UK, valves and associated products is equally measured in hundreds of millions. And we have one specialist business, Hydrovalve, that's strong in that marketplace and around about 10% of what FLOWTECH does. So whilst for clarity of message we talk about fluid power, the potential to expand in other areas is considerable. And obviously, once you're on an online platform, expansion into other areas you can do. Major players in this marketplace, RS Components, for example, what's now badged the Rubik's, former Brammer business, Eric's, equally are multi-product set areas. We ourselves as being special and big in our one particular niche, but obviously online platforms implemented well, which we will do, gives us some scope there for sure. What do you see as the great risk to the business moving through 2021? Well, hopefully you've seen, we've shown resilience in a number of areas. We don't have any specific exposure to particular sectors. Construction, yes, is historically the largest element of what we do, but I think generally there's a sense of positivity about the construction sector. And the long-term view, when we do give market information in our report and accounts from Oxford Economics, is that undercurrent of construction activity will act as a constant GDP plus driver in the overall sector. The dynamics of the supply chain, probably there's heavy elements towards China, both as alluded to, an element to what we do, but overall in global supply chain. So you've got the political type situation longer term, but hopefully relatively low risk. But beyond that, we have a full review of the risk areas in our report and accounts of each one we believe are well under control. Largest operator with the main competitors, well, as I've talked about at the top end, you've got the Irish Components, Rubik's, Eric's, chains, all 1 billion, 2 billion plus organisations across Europe. But in the UK, much more modestly sized against ourselves, and all of them are actually top 20 customers, just gives you a sense of where we sit. Outside of that, very fragmented in small owner-managed businesses in the UK and Ireland. So nothing that is a very clear and obvious danger to our competitive position. What are the ROCE targets for each of the businesses? Rather than talking investor speak, I'll talk a bit more about how we approach this from a working capital and overall investment in a profit centre basis. Our entire remuneration policy in the group is based around return on capital set at 20% of the specific working capital invested in that particular business. We historically have businesses that have operated at 40 to 50%. You apply leverage to that, you can do the mathematics yourself. So we believe that the innate returns that can be created from our already established businesses is strong. If you look at multiples in our marketplace from, say, M&A activity, we've historically, acquired businesses at circa 5 and 6 times multiples, and we've nothing to suggest at the current time that will change in the medium term. Could you describe how FLOWTECH and Fluid Power Group work together? Well, there's 2 key areas. One is sharing of operational resources. They can work from the same logistics platform. And secondly, you've got the sharing of the key brands. Historically, FLOWTECH had a heavy Far East own brand element to it, supported by certain of the key brands, whereas Fluid Power Group specialised in hydraulic top-end global brands such as Danfoss, Eaton, Parker, etc. The 2 branding styles currently in separate IT environments will come under one single e-business platform. So FLOWTECH can sell previously specialised hydraulic brands, and at the same time Fluid Power Group can get access to their logistics capabilities and therefore create a complementary arrangement there.
Bryce, I'm just cutting in just on the basis that I think you've taken every question that's come in from investors. So thank you to both yourself and to Russell for being so generous with your time, and perfect timing as we come up to the hour anyway. Unless there's anything further to add, perhaps I could just ask you for a few closing comments, and then what I'll do is, I know investor feedback is important, I will end the session and redirect investors to provide you feedback.
I'll just, the beauty from my point of view of being a CEO who used to be a CFO is that he's all over the numbers, so I can just listen intently. But just there was one subsidiary point to Jerry's question, I think, around the piece about investing in our own inventory. So just to pick up on that, I mean, for clarity, we're not looking to go mad. We're looking to sort of sensibly reinvest, and with our more popular, faster moving items, and clearly to the extent that we've got the benefit of having the supply on our shelves and our competitors haven't, and a significant demand, well, yes, we should be able to improve the margin, to your point, Jerry, there. So.
For those investors who followed our story and equally are looking at, so why is the share price, relatively modest in terms of where it sits? We floated £1 in 2014. I would look at it in 2 ways. One is the period in which we did significant expansion through M&A activity was driven by opportunity, a surprise at the scale of the opportunity during those early days, and without question that worked in terms of building scale. Behind that, I was obviously involved in every step of that particular way. I think without question, there were difficulties in integration, difficulties in ensuring that we built the platform. Hopefully, observers will say the last 3 years, our last acquisition of Bow Manor and Derrick Lane under the blue banner in March 2018 has been a very successful investment for us, funded with a 10 million fundraise at that particular point in time. But we've now spent 3 years working tirelessly on the platform in terms of understanding the dynamics of our business and building IT resources, management resources, and a clear understanding of our position in the marketplace. We're now ready to continue organic growth as we all recover from the COVID-19 period, but effectively the levers of growth as we move forward remain organic and inorganic in terms of our sort of potential. And I think with the reset, shall we say, of our dividend policy, that should give us the resources internally in terms of our cash generation to ensure we create the snowball that we've always sought from this perspective. Hopefully, we're reasonably open in our sort of style and approach to shareholders. So anybody on this call would like any further information about the organisation, you can connect us, through the usual channels, our PR, Fiona Tooley, and obviously through the usual sort of connections by email. So hopefully you found that informative. FLOWTECH is a business very much at a point of a move on again, a relaunch, so to speak. And we think we've put the platform in place for us to move on from where we are today.
Bryce, Russell, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you access this meeting from our website, then the feedback page will appear. You'll simply be asked to simply complete the feedback. And if you access this meeting via the link sent to you by email, you'll simply be asked to log back in and submit your feedback. And we'd be very grateful. And I think it'd be a great benefit to the company to understand your views and expectations. On behalf of the management team of FLOWTECH Fluid Power, I'd like to thank you very much for attending today's presentation. That now concludes today's session, and good morning to you all. Thank you once again.